Hello everyone. Sorry we are a bit late today, but we are going to start with the continuation of our mock paper of pre-September 2023. So there, I guess section A, section B was already dealt with in the last class. Now we are going to be continuing with the section C sums. So let's get started with the section C sums. We'll just start in 2 minutes. Okay guys, so sorry for being late. Let's get started with the remaining portion of our mock paper, that is the section C sums that we'll be solving today. This is the same walkthrough that I'm going through right now that we had done last class for solving this mock paper. Okay. So you go to pre-September 2023 mock exams and you can just click on resume there. Go to navigator. All these are already complete as we had done it in the last class. So we'll just continue with section C, question number 31. Okay. Now, this question, we'll simultaneously be solving it on Google Sheets because here it will be not clearly visible that what are the sums that are solved, right? Okay. So let us first look at the question clearly, then deal with the other components of the question, right? So now, here guys, there is Dorrit Company. So Dorrit Company has acquired 75% of the equity share capital of Twist Company on 1st July 2008. The acquisition took place by means of a share exchange of 2 shares in Dorrit Company for every 3 shares acquired in Twist Company. So as you can see, there is a share exchange here and it will be included in the cost of investment for calculation of goodwill, that is working note 3. At the date of acquisition, shares in Dorrit Company and Twist Company had a market value of $3.2 and $2.3 each respectively. The remainder of the consideration was payable on 1st July 2009. Dorrit Company will have to pay 28 cents for each acquired share in Twist Company. Dorrit Company has a cost of capital of 8% per annum. None of the consideration has been recorded in the books of Dorrit Company. Right? So here we are going to record all these transactions in Dorrit's book. Okay? And that is nothing but included in the calculation of our goodwill. Right? We have been provided with a statement of profit or loss here, also a statement of financial position, let us look at what is required here. So the requirement here is calculate the goodwill which is arising on the acquisition of Twist company. You have to also calculate the following amounts for presentation in the consolidated statement of financial position. That is nothing but group retained earnings and non-controlling interest. So they are asking you to calculate the goodwill, which is working note 3, group retained earnings working note 5, and also non-controlling interest working note 2. So technically you have to prepare almost the full of the working notes of consolidated statement of financial position. And lastly, they are asking you to prepare the consolidated statement of profit or loss and other comprehensive income for the year ended 31st December 2008. Okay. Now, oops, I think the page just got shifted. We were on the 31st question. Yeah. So you have to prepare a consolidated statement of profit or loss and also prepare 3 working notes which is associated with the consolidated statement of financial position. Okay, and is the reason I probably wish they have provided you with both the statement of profit or loss and the statement of financial position. Now, um, the following information is relevant. So there are 5 adjustments here also, right? So let us look at those adjustments. The following information is relevant. First one, immediately after the acquisition of Twist company on 1st July 2008. Firstly, let us look when was this Twist company acquired? It was acquired on 1st July 2008, and you have to prepare the financial statements for the year end 31st December. That means it is a mid-year acquisition, correct? Now, the Dorrit company has transferred an item of plant which had a carrying amount of 3 million to Twist company for an agreed price of $5 million. Okay, so its carrying value is $3 million, but the agreed price for it at which it was sold is $5 million. That means this is an intra-group transfer of non-current assets. At this date, the plant had a remaining life of 2.5 years. So, if to charge depreciation of 2.5 years, and that will also be done 6 by 12 because obviously this is a mid-year acquisition of a subsidiary, right? Dorrit company has included the profit on this transfer as a reduction in its depreciation costs. All depreciation are actually charged to the cost of sales, right? So every relevant information for the preparation of financial statements is provided here. In the second adjustment, at the date of acquisition, the fair values of Twist company's assets and liabilities were equal to their carrying amounts, but with one exception of Twist company's property. Okay, so the property had a fair value of 14 million, which is above its carrying value, right? So that means this is a fair value adjustment at the date of acquisition, correct? So this will be included as a fair value adjustment. For consolidation purposes, this led to an increase in the depreciation charges in the cost of sales of $350,000. So that means they've already calculated the depreciation for you. That is $350,000. But the only thing is that this depreciation is calculated for the whole year, correct? So in the post acquisition period to 31st December 2008. Okay, it is not calculated for the whole year, guys. It is clearly stated here that it is calculated in the post acquisition period. That is nothing but by the year end 31st December 2008. Okay. Now, Twist company has not incorporated the fair value increase in its separable financial statements, right? So we are supposed to do that. The policy of Dorrit Company Group, is to revalue all its property at the fair value at year end. On 31st December 2008, the increase on 31st December 2008, the increase in Dorrit Company's property has already been recorded. Okay. However, a further increase of 21 lakh in the value of Twist Company's property from the date of acquisition till the year end has not been recorded. So this is a revaluation surplus after the acquisition of the subsidiary company. So this will separately be stated in the OCI, right? In the period since the acquisition, okay, I hope it is visible to you like this. Yes. So let us just try to make it as big as possible. Yeah, because I think then probably my picture will cover the letters, right? So I'll just shift this side a little bit, so possibly it's pretty clear. So in the period since the acquisition, there was adverse publicity concerning one of Twist Company's major product lines as the result of the goodwill which arose on the acquisition of Twist Company, which has been impaired by 18 lakh as at 31st December 2008. Goodwill impairment should be treated as an administrative expense, right? So there is a goodwill impairment, and goodwill impairment is going to be charged, that is going to be 18 lakh in our working note 3, right? Dorrit Company's policy is to measure the non-controlling interest at fair value, and for the purpose of measuring non-controlling interest, assume that Twist Company's share price at the date of it is representative of the fair value of shares. So they have given obviously Twist Companies, that is the subsidiary company's share value. So you can calculate using that share value your financial statements, okay, your NCF, right? So now let's get started with the calculations. So firstly, we will prepare our first working note. Okay. Our first working note is going to be prepared, which is going to be nothing but the group structure. That what is actually the group structure, right? So here, Dorrit Company has acquired a subsidiary company, namely Twist Company, right? Dorrit Company has acquired a subsidiary, that is Twist Company, and that is nothing but on 1st July 2008, right? You can see here on 1st July 2008, this company was acquired, right? And 75% of the equity shares have been purchased. That means 75% of the company has been acquired, right? So 75% has been acquired. Moving on to working note 2, I'll just prepare that also, even though it's not required because we need it in our calculations. That is nothing but net assets of subsidiary company, that is Twist Company. Here the net assets of Twist Company will be at acquisition. At the reporting date, I'll just write R and RD, that is the reporting date, and we will get the differences as our post acquisition. Correct? Firstly, we have been provided as the share capital. Correct? So the share capital probably is provided in the statement of financial position. Okay, assets. Yeah. Equity. Equity share capital of the subsidiary is going to be 31,500, right? You can see here 31,500. Right? That is not going to change because it is of the subsidiary. Then after the share capital, if in case there is any share premium or else retained earnings. No, there is no share premium. We can see our retained earnings. So the retained earnings are nothing but 12,250. Now here there is also revaluation surplus provided, but the revaluation surplus is only of the parent company, not of the subsidiary. If there was a value here of the subsidiary company, this is a pre-acquisition revaluation surplus, which would probably be stated here. Okay. So here the retained earnings are nothing but 12,250, right? So I'll just write retained earnings. Retained earnings at the year end are nothing but 12,250. Correct? So if the retained earnings at the year end are 12,250, whatever is the subsidiary's profit. So here let us look at the profit. Yes. So the profit of the subsidiary is 7,000. Now this retained earnings, which is at the reporting date, that is for the full year, correct? At the reporting date, the retained earnings, that is 12,250, that is for the complete year, right? That includes the profit of 7,000 of the complete year, right? So we have acquired the company mid-year, correct? Now since we have acquired the company mid-year, we are not going to include the pre-acquisition profits, right? So 7,000, this will be allocated, or you can say distributed amongst the first 6 months where we did not acquire the subsidiary company, right? So 7,000 into 6 divided by 12. The first 6 months where we did not acquire the subsidiary company. So if we subtract this from the 12,250, we will get the retained earnings of the subsidiary company at acquisition, right? So the retained earnings of subsidiary company is going to be nothing but 8750, right? And this is the post acquisition profit that we get currently, right? So it will be nothing but 8750, which is the retained earnings of the subsidiary company at acquisition. And the difference between the two is going to be nothing but 3,500, which is the post-acquisition profits, right? Now, others are actually mainly adjusted in the adjustments which are provided here. So before doing that, I'll just prepare the base here, right? So we'll just do working note 3 because any which ways, adjustment of goodwill is the first adjustment which is stated here, which is cost of investment. That is your share exchange for purchasing the company and whatnot, right? So the cost of investment, firstly, I saw there is a share exchange. So in case of a share exchange, guys, what is the scenario here in case of a share exchange? It is actually, you can see here, the acquisition took place by means of a share exchange of 2 shares in Dorrit company for every 3 shares acquired in Twist company, right? So what are the number of shares that is that Twist company is having? That is 31,500, correct? So it is 2 shares given by Dorrit company for every 3 shares acquired in Twist company. Now how many shares are acquired? First we have to identify that. So in order to identify that, 31,500 is the total number of shares. Into we have purchased 75% of the company. So that means 75% of the share capital into 2 shares given divided by 3 shares received on acquiring the company into whatever is the share value of the parent company, right? So the share value of the parent company at the date of acquisition is nothing but $3.2 as you can see here, right? So I'll just mention that $3.2. So our total will be nothing but 31,500 into 75% into 2 divided by 3 into $3.2. So that will be nothing but 50,400, right? So 50,400 guys is nothing but our share exchange that we have calculated. Then also I guess there is a deferred consideration, right? So there is a deferred consideration here, I guess. The remainder of the consideration was cash payable on 1st July 2009. So that means we are going to pay certain cash after a year, right? So Dorrit company is going to pay how much? Dorrit company is going to pay 28 cents for each acquired share in Twist company, right? So how many shares are acquired in Twist company? 31,500 into 75% shares are acquired in Twist company into 0.28 because it is 28 cents paid for each share, right? So $0.28 or you can also write 28 cents, but it will be better if you calculate it this way. Into you have to actually consider the present value, right? So for considering the present value, they have given us the cost of capital to be 8%, right? So the cost of capital is 8% per annum. So we will just apply the formula that is nothing but 1 divided by 1 plus R is nothing but 8%. That means 0.08. And since it is paid after a year, raised to 1, right? So that means technically it is nothing but into 1 divided by 1.08, right? So this is the complete calculation for your deferred consideration. So it will be nothing but 31,500 into 75% into 0.28 into 1 divided by 1.08, right? So our value is going to be nothing but 6125, right? So I think we have included everything that was to be included in the cost of investment. Now we'll just identify the non-controlling interest. So as we have already seen the non-controlling interest, for that we have to take the share value at the date of acquisition. And always remember, for calculating fair value non-controlling interest at the date of acquisition, you have to always take the subsidiary's share price at the date of acquisition. Okay. So what is the shares which are belonging to the non-controlling interest? 31,500. Since we have acquired 75% of the company, 25% belongs to the NCI into what is the share value of the subsidiary at the date of acquisition? It is nothing but $2.3, right? So we're going to take $2.3, right? And our value here will thus be 31,500 into 25% into $2.3, right? So that will be 18,113 approximately, right? So here guys, we have calculated all the necessary adjustments or all the necessary mentions that were supposed to be stated. So I hope till here it is clear to everyone. Now, moving on further. So we will have our working note 4 also. That is nothing but non-controlling interest, right? Now, non-controlling interest is already calculated. NCI at fair value is already calculated in the previous working note. In working note 3, you can see here this value. So I'll just copy paste that value. And here, if in case there is any share, NCI share, okay, post acquisition NCI share, I'll write that. Right? So post-acquisition profits, NCI share, that will be added here. Then whatever will be there will be the necessary adjustments to be made. Then lastly, we will have a working note 5. That is going to be nothing but group retained earnings, right? So in the group retained earnings, we'll take the parent's retained earnings. That is going to be nothing but as stated in the question directly, the retained earnings of the parent company is 22,050, right? So 22,050. This is the parent's retained earnings. Then the post acquisition profit share of the group, right? So that will be included here, right? That will be added to the group retained earnings. Now let us look at the adjustments one by one. I'll just prepare a working note here separately. Working note 6 probably. Yeah. So, sorry guys. Immediately after the acquisition, Twist Company of Twist Company on 1st July, Dorrit Company has transferred an item of plant, right? And it had a carrying value of $3 million. Who has transferred the plant? Dorrit Company. So $3 million is the carrying value and its agreed price is $5 million, right? So that means here we have a non-current asset transfer, and here we will also state Dorrit Company is the seller, right? Or you can also mention parent is the seller. In examination, you do not need to mention all that. You can just prepare the working note directly. This is for your understanding, right? So here we will have without transfer, we will have with transfer, and we will have the perp adjustment that is required to be made, right? So firstly, whatever is the cost, so the cost without transfer, it is sold for how much? Without transfer, it is technically sold for, sorry, without transfer, it is having a carrying value of 3 million, correct? So I'll just write here 3,000 and it was transferred at a price 5,000. That means there is a perp of nothing but 5,000 minus 3,000, that will give me 2,000, right? Then there is a depreciation on the asset which will be calculated for calculating the carrying value of the asset at the year end. So at this date, the plant had a remaining useful life of 2.5 years. So we will charge depreciation of 1 divided by 2.5, right? Into 6 divided by 12 because we have to charge depreciation of only 6 months. So 3,000 divided by 2.5 into 6 divided by 12. That will be 600 and here it will be 5,000 divided by 2.5 years into 6 divided by 12, right? So the differences in the depreciation is nothing but 400, right? Now the depreciation has been calculated. Now let us actually calculate the carrying value, right? So the carrying value is simply going to be nothing but 3,000 minus 600, and here also I'll just drag it so that we get the answers for all three of them. Here it will be 4,000 and here it will be 2,400, right? So here what adjustments we need to make? Firstly, the adjustments that are required to be made is nothing but we'll pass the journal entry because Dorrit Company, that is the parent company, is the seller here. This shall be reduced from the group retained earnings, right? That is nothing but our working note 5. So group retained earnings account will be debited, right? Because here Dorrit Company has made a profit by selling it at a value which is higher than its carrying value, right? So here profit shall be reduced to your non-current asset shall be reduced by the amount 2,400. And obviously the last journal entry of it will be nothing but my working note 2, that is going to be the net assets of subsidiary at acquisition, right? Of subsidiary company, right? That is working note. So that will be increased by 400. Right? So your non-current asset is actually reduced because it is credited. It is reduced by 2,400 because 2,000 is the profit, right? Oops, I made a mistake here. This should have been a negative amount, right? So here it will be 1,600, not 2,400. I'm so sorry, guys. So 1,600 is the value by which your non-current asset shall be reduced. Why is that so? Because obviously, simply here, your asset has had a value of 3,000, and technically, if you would have charged depreciation of it, it would be 600, right? So 600 is the depreciation that should have been charged, correct? Now, you made a profit on the asset, correct? The parent company sold the asset and made a profit of 2000. Now, this is an unrealized profit. So, when we add the assets, right, the subsidiary will recognize the asset at a value 5,000 because they purchased it at 5,000, correct? But this includes the unrealized profit of 2000. So, from 5,000, this 2000 shall be subtracted, right? But by the year end, the depreciation is also charged, and the subsidiary, since had the asset at a value 5,000, they charged excess depreciation. The depreciation that should have been charged is 600, but they charged a depreciation of 1,000, right, guys? They charged a depreciation of 1,000. So that excess depreciation which is charged by the subsidiary, that shall be added back here. That will be 400. And thus the net adjustment that you're supposed to make in your consolidated statement of financial position will be nothing but, oops, will be nothing but this adjustment that I've explained you. It will technically be 1,600, right? 1,600, it will be reduced by 1,600. Okay. Now guys, your non-current asset is stated here. I explained you the adjustment that you require to make in the consolidated statement of financial position. Now in the consolidated statement of profit or loss, what will you do? You will be doing nothing but the cost of sales account will be debit, right? Two non-current asset will reduce and two cost of sales will also reduce. And the values of it is going to be nothing but 2000, 1600 and 400, right? What is this adjustment? It is the adjustment to be made in your consolidated statement of profit or loss, right? So you're reducing your asset value by 2000, correct? It should be reduced by you have gained a profit of 2000. So it must have been stated in the revenue of the parent company of 2000, or probably somewhere your profit is increased, correct? So that profit is reduced by adding the value to the cost of sales, right? Because you want a profit of 2000, it shall be reduced from the cost of sales. It shall be added to the cost of sales to reduce the profit by 2000, right? But you have also charged excess depreciation, right? So that excess depreciation, that will be credited back. That means that will be subtracted from the cost of sales, this 400. So that means the net adjustment in the cost of sales will be 1600, right? And to non-current assets on the face of statement of financial position, it shall be reduced by 1600, right? This was the complete explanation of the non-current asset transfer. Okay, moving on to the next adjustment. Okay, at the date of acquisition, the fair values of Twist Company's assets and liabilities were equal to their carrying amounts, with the exception of Twist Company's property, which had a fair value of $14 million. Okay, which is above its carrying amount. For consolidation purposes, this led to an increase in the depreciation charges, right? And the depreciation is also given 3,50,000. Don't time apportion this, because this depreciation is charged from the date it was acquired. Here's the reason why they stated 3,50,000 is the depreciation charged in the post acquisition period, correct? This is the depreciation charged in the post acquisition period. So we'll just calculate that. That is just directly adjusted in our working note too. So there will be a fair value adjustment of nothing but 14,000, correct? So we will state here nothing but the value which is going to be 14,000. And we will calculate the fair value depreciation which is to be charged. That will be nothing but 3,50,000 which is already given. So that will be 350 subtracted. I'll also state it here. Okay. Then we have calculated the PERP, right? The PERP which is to be stated in working note, which was working note 6, right? That PERP of 400 will be added back because it was depreciated at a higher value for the subsidiary company, right? So I guess we have made all the adjustments to the working note too, all the necessary adjustments, right? We'll just look at the question if anything else is pending. Now, the policy of Dorrit Companies Group is to revalue all the properties to fair value at each year end. Okay, so this is done directly on the face of statement of financial position and the profit or loss. In the period since the acquisition, there was an adverse publicity concerning one of the Twist company's major product lines, as a result of which the goodwill which arose on the acquisition of Twist company, which has been impaired by 18 lakh, right? And goodwill impaired should be treated as an administrative expense. That means I'll add it to the administrative expenses. The last adjustment is for non-controlling interest, and since it is a mid-year acquisition, they are showing that all the items and all the items of income and expenditure are assumed to be accruing evenly throughout the year, right? So here I don't think there is any other adjustment required to this working note, so I'll just close this working note and I'll just total them. Yes, that is 54,250. 400 will be added here. And we get the values to be 57,800 and the post acquisition profit of 3,550. So our goodwill also minus net assets at acquisition, net assets of subsidiary company at acquisition, which we have calculated in the earlier working note, 54,250, right? So we get the goodwill. So the goodwill is going to be nothing but, guys, 20,387, right? I'll just add one more row here. Yeah. So the impairment now which is charged to the goodwill, the impairment which is charged is nothing but 1,800, right? So I'll just charge the impairment also here, guys, which is going to be, where is it? Yeah, that is going to be nothing but $1,800. So let us charge the impairment minus 1,800, and thus our goodwill is going to be nothing but 18,587.5, right? So we have got our goodwill here, guys. Now we'll just take the NCI. So the NCI profit share is going to be nothing but whatever is the profit multiplied by the NCI percentage, right? So the post acquisition profit is 3,550 into NCI percentage, that is 25%, right? Then in working note 5 also we'll do the same. That is going to be nothing but 3,550 into 75%, which belongs to the group, right? Then the goodwill impairment shall be allocated to NCI. Here also it will be allocated the goodwill impairment. So what is the goodwill impairment which is allocated to NCI? So you can see here the complete goodwill impairment is 1,800. So I'll just click on 1,800 and it will be multiplied by the 25%, right? So the goodwill impairment allocated to NCI is 450 and the goodwill impairment which will be allocated to the group retained earnings is 1,800 into 75%, right? So that will be 1,350. I don't think there is any other adjustments which are required to be made to your NCI. So we'll just calculate the totals of your NCI, right? Yeah. So let us calculate the total of the NCI. I'm so sorry, guys. Our total of NCI is 18,550. And here, for the retained earnings, anything else is pending? Yes, obviously your non-current asset transfer, group retained earnings is going to be reduced by 2,000, right? So your perp of working note 6 will have a reduction of $2,000 in the retained earnings, right? So I think we have made all the necessary adjustments here except for the unwinding of the discount, right? So if you remember here, we are supposed to unwind this deferred consideration, right? So the what is the value of the deferred consideration? It is nothing but 6125, and we have calculated that this present value by taking 8% as the cost of capital, correct? So now guys, if we want to calculate the future value, that means we have to calculate the finance cost on it, 6125 into 8%. So we will get the finance cost, that is going to be 490, right? So finance cost, account debit to, you can say your, here you, instead of finance cost, you can also adjust it directly in your working note 5. That is, you can debit the group retained earnings, and you can say here that your liability is being increased by this. Okay, because you have to anyway state the finance cost as an unwinding, right, to your group retained earnings, right? So that will be 490 and 490, correct? So I'll just state that unwinding of discount, unwinding of the liability, right, deferred consideration, and that will be deducted by 490, right? So I think we have made the necessary adjustments to the group retained earnings. We'll just do the total of this, and the total of the group retained earnings, guys, is going to be nothing but 20,872.5. Okay, so we have calculated all the adjustments here necessary, right? I hope it is completely clear to you all, right, guys? Now we'll just continue with the latter part, but before that, I forgot to mention one thing. We have actually calculated here the finance cost for the full year, right, guys? But the finance cost is not going to be for the full year, it is going to be for 6 months. So this will be into 6 divided by 12, correct? So it will be 245, right? I forgot to mention that part. So here the reduction is not going to be 490, the reduction is going to be 245. And thus the group retained earnings that we've calculated is 21,180, right? Now we are done with all the adjustments here. Is there any other adjustment pending? Okay, I don't see any other adjustment pending. So we've calculated the goodwill at acquisition. So the first part is done here. We've calculated the following amounts for presentation in the consolidated statement of financial position, which is group retained earnings and non-controlling interest. Now we'll start off with preparing the statement of profit or loss. We'll just be back from a 2-minute break, guys. Sorry. I'm sorry guys, let us continue with the latter part. So here we are supposed to prepare now the consolidated statement of profit or loss and other comprehensive income for the year ended 31st December 2008. We are done with all the working notes. Let's get started with the preparation, right? Yeah. So we are preparing the consolidated statement of profit or loss for Dorrit Company for the year ended 31st December 2008. Yeah. So let's get started. Firstly, we will have our revenue. So for the revenue, guys, it is going to be 2,22,000 plus 1,04,900 into 6 by 12, correct? 900 into 6 divided by 12. So our revenue is going to be nothing but, okay. But before that, is there any other adjustments to be made? No, there is no perp or any other adjustments which is required, right? Because the non-current asset transfer, it does not affect your revenue, right? So here it is going to be nothing but 222, wait, it will be 1,04,900 into 6 divided by 12 plus 222,000. So that will be 2,74,450, correct? So this is our revenue. Then for the cost of sales, it will be 1,61,500 plus 83,900 into 6 by 12, right? So cost of sales will be nothing but 1,61,500 plus, what is the last value? 83,900, right? So 83,900 into 6 divided by 12 minus the adjustment to the cost of sales for the PERP for the non-current asset transfer, and fair value depreciation is also there. So for the fair value depreciation, what is the depreciation? It is 350, right? So I'll just reduce that 350. Then goodwill impairment is not allocated here. It is stated in your uh, it is stated in your administrative expenses, right? So I think these are only the necessary adjustments to be made here. So we'll just calculate the total cost of sales. It will be nothing but 83,900 into 6 divided by 12 plus 1,61,500 minus 1,600 minus 350. Okay, 1,600, sorry, is to be added to the cost of sales, correct? So I'll just put an addition here. The PERP and the non-current asset transfer, they are added to the cost of sales. So it will be reduced from your gross profit, correct? So that will be nothing but 2,05,400. I'll just write an addition sign here. Because if it is added to the cost of sales, that means technically we are eliminating the unrealized profit. And also for the fair value depreciation, we are adding up that depreciation. So our gross profit is going to be nothing but this value, which is the revenue minus the cost of sales, that will be 69,050, right? Now next is what? Next is your distribution cost. That will be 6,900 and 4,200. So distribution cost 6,900 plus 4,200 into 6 divided by 12, correct? So here it will be nothing but 4,200 into 6 divided by 12 plus 6,900, which will give us a value of 9,000. I'll just state here negative signs. So it will be a negative amount, 9,000, right? So our distribution cost, guys, here is 9,000. There is also administrative expenses. Which will be nothing but 13,100 and 6,300, right? So 13,100 plus 6,300 into 6 divided by 12 Also here the goodwill impairment is going to be added, which is nothing but 1800, right? So the goodwill impairment added here 1800, and the total will thus be 6300 into 6 divided by 12 plus 13,100 plus 1800, right? I'll just put here negative signs, so then it will be a negative amount which is to be stated, right? So it will be 18,050, and thus from this we get the profit from operations, and that is going to be nothing but 42,000, right? So the profit from operations, guys, is going to be nothing but 42,000. Now we'll take the finance cost, right? So what is the finance cost? The finance cost is nothing but 800. But to this also that unwinding finance cost is going to be added. So it will be 800 plus what is the finance cost related to the unwinding? It is 245, correct? So I'll just take that 245 here. So 800 and 245. The total finance cost is going to be 1045. From this we will get the profit before tax. So guys, here what will be the profit before tax? It will be 40,955, right? Now lastly, the tax expense will be charged here. What is the tax expense, guys? The tax expense is nothing but 10,750 and 3,500, right? So 10,750. Firstly, 3,500 will be 6 by 12, correct? Into 6 by 12 plus 10,750. That will be 12,500. I'll just put here negative signs. So it will give me the tax expense for the year. Again, restating the values here just for clarification, 10,750 and 3,500. 3,500 into 6 divided by, correct? So this is the tax expense, and thus the profit for the year that we will get is going to be nothing but 28,455. So we have got our profit for the year, guys, which is nothing but 28,455. Now this profit for the year is going to be actually allocated to the NCI and the parent. But before doing that, since we also have an OCI, first we'll actually prepare the OCI, then show the attribution, right? Then show the allocation between the NCI and the parent company or the group, right? So firstly, in the OCI, we have the profit from operation, correct, guys? Sorry, not the profit from operation, the revaluation surplus, right? So what is the value of the revaluation surplus? It is nothing but 2,100, because your asset of the subsidiary was revalued, correct? So the asset of the subsidiary was revalued, that you can see in the adjustment here. It was revalued. See here, it was revalued by 2,100. So this revaluation surplus will be stated here. And also there is a revaluation surplus balance here, guys, of 6,000, correct? So since there is a revaluation surplus balance here of 6,000 and there is a 2,100 increase in the revaluation surplus, we are going to take them both. Okay, guys. Now, sorry, the gain on revaluation of property, it is here 5050, not the revaluation surplus, right? I was taking a wrong amount. It is clearly stated in the statement of profit or loss. We are not preparing the statement of financial position, correct? We are not preparing this part. We are preparing here, so we'll take the amount from here. So it is 5050, which is the revaluation surplus stated. So 2,100 plus 5050, which is going to be nothing but 7,150, and thus the total comprehensive income that we get for the year is going to be 35,605. Now, firstly, the other comprehensive income, firstly, the profit for the year, and thus after that, the total comprehensive income will be allocated between the NCI and the group. Correct? So, we'll just do that. Now, firstly, guys, it will be allocated to the NCI, profit attributable to the NCI and also to the group, right? So how much will be allocated to the NCI? It will be nothing but the profit of NCI for the year. So as you can see in the question, it is clearly specified that the profit for the year of the of the subsidiary is nothing but 7,000, right? So how do you calculate NCI? The profit of the subsidiary company, that is 7,000. But since it is 6 by 12, we will take 6 by 12. It was a mid-year acquisition of the company. From this, we are going to deduct, what we are going to deduct, guys? Here, the non-current asset transfer, correct? The non-current asset transfer is going to be deducted. What else is going to be deducted? The fair value depreciation, right? So here the fair value depreciation is how much firstly? The fair value depreciation is 350, correct? So 350 will be deducted. And regarding the non-current asset transfer, if you remember, there was an excess depreciation. So that excess depreciation adjustment will be added back here. But not the whole amount is going to go to your PERP. It is going, not the whole amount is going to go your NCI, it is going to be just 25% of the total adjusted profit, correct? So what is our adjusted profit? It is nothing but 7,000 into 6 by 12, which is 3,500. From this, we are going to deduct 350, right? So I'll just directly do the calculations here. Okay, I won't be able to do it. I'll just state it separately. It will be 3,500. That is the profit of the subsidiary minus 350, which is the fair value depreciation, and addition of 400 because excess depreciation was charged to the subsidiaries financial statements, correct? So the adjusted profit is nothing but 3550, which we have already calculated, right? So 3550 into 25%, that is going to be the profit attributable to NCI, right? That will be 897, and to the group it is nothing but a balancing figure. That will be nothing but the profit, that is 28,455 minus 887.5, that will be 27,567.5, right? This is the profit for the year which has been allocated between the non-controlling interest and the group. Now, total comprehensive income allocated between the attributable to the non-controlling interest and to the group, right? So what will be the total comprehensive income here? It will be the same. So I'll just copy paste this firstly, right? So NCI will be this. Okay, I won't be able to wait. I'll just show you the calculation. So NCI will be nothing but firstly we took the profit for the year, that is 3550, which we've calculated here. So I'm just taking directly the adjusted profit, plus there was a fair value increase in the NCI's assets, that is nothing but the revaluation surplus. So that, and we will multiply this with 25%, correct? So here our value of NCI will be nothing but 3550 plus 2100, that is going to be nothing but 5650. So it will be nothing 5650 into 25 divided by 100. This is the total comprehensive income which is allocated to the non-controlling interest, and from the total comprehensive income, that is 35,605, we will deduct this value which is attributable to NCI, and we will get the value which is given to the group, that is nothing but the balancing figure, right? I hope this sum is clear, guys. I hope you've understood everything here, be it for each and every calculation, right? And yes. So I think we are done with all the necessary calculations here. I hope it was completely clear to all of you, right? Now we have prepared the statement of profit or loss. We've done the necessary adjustments for each and every working note, and also be it for the finance cost, be it for the group retained earnings. So I hope this part is clear. We'll restart the class in 20 minutes after a 20-minute break. Thank you guys. We'll continue in 20 minutes. Hello guys, let us continue with the remaining part. So heading on towards the last sum of our this examination, that is the pre-September mock 2023. Okay, I've reviewed the whole thing. I don't know why it is showing like that. Okay. So now moving on to the next question here. This question is for Griffin Company, right? You have to calculate the equivalent ratios to those in note 1 above for the year ended 31st December 2008. After that, you're also required to calculate the equivalent ratios in note 1 above for the year ended 31st December 2007. So that means you have to calculate it for 2 years, right? Excluding the contribution made by the division that has been sold. So if you remember one thing, for your this year FR changes, guys, there is a change which is added, which is not technically a change much, but it is stated that for your this examination, for your this year examination, your asset your operation this which has been sold or discontinued, that is also going to be examinable in section C. So here, as you can see, there is a disposal of an operation. So here we are going to also deal with the calculations of the disposal. So in case of calculating the ratios, whatever are the disposal related values, those are going to be removed from those ratios. So they are requiring you to calculate that. Your answer should provide any explanatory notes for the calculations where appropriate. So where if you want to provide any notes to the calculations, that how the calculations are done, you can also provide for that. Lastly, you're supposed to analyze and compare the financial performance and position of Griffin Company for the year ended 31st December 2008 and 2007 based on the ratios calculated in Part A. So your analysis should make reference where relevant to the industry average equivalent ratios. So you have to also use the industry average equivalent ratios. Okay. So let us get started with the question understanding. Right? So here the scenario relates to the three requirements that are there, which is mentioned in the question. Firstly, they've provided to us the statement of profit or loss, and I guess the statement of financial position as well. Then they've given us four ratios, guys. That is nothing but the return on capital employed. Then there is your gross profit margin. So return on capital employed, they've stated that it is calculated as total assets minus current liability. So we'll do that. Then operating profit margin is also clarified here, interest cover and net assets turnover. So we are going to calculate these five ratios for 2007, the adjusted values excluding the contribution from the disposal, right, of the disposal, and also for 2008, right. By the end of 2007, Griffin Company concluded that one of its divisions was no longer a good fit with the company's strategy. So on 1st January 2008, Griffin Company sold the net assets, including the goodwill on the division, which had been independently operated, right, for 19.2 million cash. That means they sold it for 19.2 million and they earned a profit on sale of $2.4 million. The division reported the following results for the year ended 31st December 2007, which have been included in Griffin Company's statement of profit or loss. So they've given you the revenue, cost of sales, the gross profit, distribution costs, administrative expenses, and lastly the profit before interest and tax. Okay. And lastly, they have provided you the industry average for the all of this for the year 2007 and 2008. That is the return on capital employed, gross profit margin, operating profit margin, and lastly, net assets turnover. So let us get started with the calculations first. We are supposed to calculate the ratios first. So I'll just mention here ratios for the year ended 2008 and adjusted 2007 has been presented below, right? I'll just mention that. Yeah. Also, whatever is mentioned as per the question, that we are going to clearly state here. So 2007, which is mentioned as per question, right? Then probably we will have our adjusted 2007, 7 ratios and our 2008 ratios, right? Oops. Firstly, I guess the first ratio that we are dealing with is nothing but return on capital employed, correct? So we are going to calculate the return on capital employed, and as per the question, it is mentioned as 53.6%, right? So I'll just mention here return ROCE, return on capital employed, right? As per question 2007, it is mentioned 53.6%, right? We have to calculate for 2008 and for 2007, correct? Now, guys, for 2007, there could be a couple of adjustments made for the formula, but for 2008, it is fairly straightforward. So I'll just do it firstly for 2008, right? So what is the formula for return on capital employed? The formula for return on capital employed is nothing but profit before interest and tax, or you can say profit from operations. I'll just mention it here. Profit before interest and tax. Okay, I'll mention it here because here I have to fit in some more things. Profit before interest and tax, or profit from operations, divided by the capital employed. And here the capital employed is nothing but the total assets minus current liabilities, right? So let us look at the total assets for the year 2008. So I'm looking for 2008 firstly. Okay. So in the year 2008, the total assets I can see here directly, it is 54,000, right? The total assets are 54,000 and my current liabilities are nothing but 13,000, correct? So my denominator, that is capital employed, will be nothing but 54,000. That is the total assets minus the current liabilities, which is stated here. The total is directly given, that is 13,000, which includes the bank overdraft, trade payables and current tax, right? So guys, what is the profit before interest and tax? Okay, so we have the gross profit, that is 28,800. Then they've included the profit from the sale of operations. So this will not be included. Then they've included the distribution cost, obviously. So this will be deducted. 11,510. The administrative expenses will be deducted. Finance cost of 10 is not going to be deducted. So technically we have to adjust this value, right? So it is going to be nothing but for 2008 I'm doing. That will be nothing but 10,320. There is a finance cost of 10, so I'm adding back that finance cost of 10, correct? So sorry guys, yeah, that finance cost will be added back. This profit is also included of 2,400, so that will be deducted because it was previously added to the profit before tax, correct? So this will be deducted, that is 2,400, right? So we get our return on capital employed, and this will be divided by nothing but the total assets minus current liabilities, which is nothing but 54,000 minus 13,000, correct? So it will be nothing but 54,000 minus 13,000. This is the calculation for 2008, right? So let us just calculate whatever is the total. 10,320, okay, plus 10. What is it? 10. I'll just do it here. 10,320 plus 10 minus 2,400, correct? So my profit before interest and tax will be 7,930 and my capital employed will be 54,000 minus 13,000. That is nothing but 41,000, correct? So here guys, my 2008 return on capital employed will be nothing but profit before interest and tax divided by the 41,000, which is capital employed, into 100. So I will get it in percentage, that is 19.3%, approximately 19.3%. Okay. Now for 2007, what will happen? So guys, for 2007, I'm just deleting this as of now. Okay, if I delete this, I think that will go off. Yes. So I'll just mention it separately since we have already calculated it. 19.3%. Correct? Now, for 2007, let us look at 2007. So as you can see, in 2007, this company was sold off, right? Maybe this operation was sold off. And you can see in note 2, they have sold off a division which was no longer a good fit for the company, right? And these are the sales revenue and everything stated for it. So we have to adjust these amounts in the calculation of return of capital employed, correct? So in case of return on capital employed, guys, what is going to be our profit for 2007? It'll be nothing but your profit before tax is 26,400. So I'll just state that 26,400 is the profit before tax, but we need profit before interest and tax, right? So 1920 will be added back because that is the finance cost charged, right? 1920 will be added back. Anything else? Okay. So 26,400 distribution costs and administrative expenses are obviously going to be deducted. So 1920 is added back. And what else? Here you can see that the profit, that the profit that is there before interest and tax, 9,900, that will be removed, correct? So that means this 9,900 will be removed because that is sold, right? We have to calculate the adjusted 2007, which does not include the contribution from the operation which has been disposed of, right? So thus our profit, our adjusted profit before interest and tax is going to be nothing but 18,420, correct? So our adjusted profit before interest and tax is going to be nothing but 18,420. Now, where is it? Where is it? Yes. So we have got our profit before tax. Now, in the later part, regarding our return on capital employed, ROCE, it is nothing but the assets that are there, correct? So, for the assets, guys, for the assets, where is it? Yeah. So for the total assets, it is 70,080, right? So for my total assets, my return on capital employed, I'll just take the capital employed. My total assets are 70,080, correct? And here also will be deducted the current liabilities, that is 17,280, correct? So minus 17,280 will be deducted as my current liabilities. Also, the profit that we have got from the disposal, right? This 9,900 profit that we have got from the disposed operation, that will also be eliminated, right? But not this profit only. There is here the asset is actually having a value of 19.2 million, correct? But it was sold for 2.4 million, right? The asset is having a value, the asset, not the operation, is having a value of 19.2 million. It was sold for 19.2 million. And the profit that we have achieved here is 2.4 million. That means technically 19, it is sold for 19.2 million, correct? And 2.4 million is the profit that we have achieved, correct? So that means what is the carrying value of this operation? 19.2 million minus 2.4 million. That is nothing but, okay, I'll just remove the million. Yeah. So 19.2 million minus 2.4 million, 16.8 million is the carrying value of the operation which is disposed of. So if that much of the operation is disposed of, technically that is not a part of our assets anymore, correct? So technically that is not a part of our assets anymore, guys. So that will be eliminated, right? So it is nothing but 16,800 which shall be eliminated, and thus the value that we get, okay, I have to put this as a negative sign, right? Thus, the value that we get is nothing but capital employed is going to be 36,000, right? So, here guys, capital employed is 36,000 and the profit before interest and tax is 18,420. So I'll just take those values. 18,420 divide by 36,000 into 100. So you will get it in percentage. That is 51.167%. We'll take it as 52%. Okay. So I'll just mention here 52%. Right? This is the adjusted 2007. What have we done here, guys? For the profit before interest and tax, we've taken the profit before tax, right? We've added back the finance cost, so we get the profit before interest and tax. The profit that was associated with the disposal operation, which with the operation that is disposed of, that is eliminated because you have to calculate as if the contribution is out, right? So the contribution is eliminated and thus we get the adjusted profit. The adjusted capital employed will be nothing but the total assets minus the current liabilities minus the carrying value of the operation that has been disposed of, right? Because that is no more a part of my asset, so it does not form a part of my capital employed. So that is how we've got 52%, right? Or not 52, I'll write it as 51.2, right? Right? So 51.2%. Now, we've got our return on capital employed. So I'll just delete this part because then we have to do more calculations here. Okay, moving on, which is the next. So next is nothing but our gross profit margin, correct? So our formula for gross profit margin is nothing but the gross profit divided by the sales revenue, correct? So the gross profit divided by sales revenue is going to be nothing but our gross profit margin, right? Now you can see here that for the gross profit, guys, where is it? Yeah. For the gross profit for 2008, it is fairly straightforward, 28,800 divided by 87,300, right? So I'll just do that. 28,800 divided by 87,300 into 100. So I will get the gross profit margin for 2008 to be 32.9%. I'll just write it directly as 32.9%. Right? Okay. So we've calculated here the gross profit margin for 2008, right? The adjusted gross profit margin for 2007 will be nothing but, I'll just open the bracket here for understanding. So guys, you can see here the gross profit is 48,000. So I'll write it as 48,000, right? Out of this, the gross profit that is calculated from the operation which is disposed, that will be eliminated, right? So here our gross profit is 15,200, correct? So 15,200 is going to be removed. Divide by our sales revenue, which is nothing but 1,18,500 minus the sales revenue associated with the operation disposed of 37,200, correct? So it will be nothing but 1,18,500 minus 37,200, right? So this is the adjusted 2007. It is nothing but 48,000 minus 15,200. So 32,800 is the profit and 1,18,500 minus 37,200, that is the sales revenue, correct? And thus the profit margin will be nothing but 32,800 divided by the sales revenue into 100. We will get it as 40.3%, right? 40.3%. And for 2007, what is already mentioned here, it is nothing but the gross profit margin for 2007 to be 32%, right? Okay, sorry, these are the industry averages. Sorry. Where is the profit margin? Yeah. 20 operating profit margin is 23.9, gross profit is 40.5%. Right? It is not 32%, that is 40.5%. Correct? So this is the gross profit margin calculation, guys. Moving on to the next part, that is nothing but operating profit margin. That is going to be nothing but operating profit, as we have already calculated. It is going to be 10,320 for the year 2008 plus the 10 minus 2,400. Correct? 10,320 plus 10 minus 2,400. This is the operating profit margin, right? The numerator of it. Now the denominator will be nothing but the sales revenue. So sales revenue is direct 87,300 for 2008. So I'll just state that 87,300, right? So my sales revenue will be nothing but, I'll just calculate it here, 10,320 plus 10 minus 2,400. So this is the profit, and divide by 87,300. Correct? So my operating profit margin will be 7930 divided by the sales revenue into 100, and it will be 9.08%. So we can probably mention at 9.1%. Right? So this is for 2008. Now let us calculate for 2007. Now for 2007, guys, firstly the gross profit is 48,000. Sorry, the operating profit is, profit before tax is 26,000, say 400. In this, the finance cost will be added back. So 26,400 plus 1920, right? Plus 1920, correct? And what else will be there? Obviously, 26,400 plus 1920 minus the profit before interest and tax, because this is directly the amount which is stated, that is 9,900, right? So this is going to be the numerator, right? I'll just put an equal to here, so we'll get the value. That is 18,420, correct? So this we have got it as the operating profit margin, the adjusted for 2007. Divide by nothing but the sales revenue. So sales revenue is going to be nothing but 1,18,500 minus the sales revenue of the disposal, that is 37,200, right? So 1,18,500 minus 37,200, which is going to give us 81,300, right? So what is going to be the operating profit margin? 18,420 divided by the sales revenue into 100, and we will get it as 22.65%, right? So we'll mention it as 22.6%. Okay. As per the question, the operating profit margin which is stated is nothing but 23.9%, correct? Always remember, guys, your calculation does not carry as much marks as your analysis and your interpretation of the financial statements does. Okay. Next is interest cover. So for the interest cover calculation, guys, it's fairly straightforward, right? So firstly, what is the formula of interest cover? So the formula of interest cover is nothing but the profit before interest and tax divided by the finance cost that is paid. So for 2008, the profit before interest and tax is nothing but as calculated earlier, 10,320 plus 10 minus 2,400, right? So it's equal to 10,320 plus 10 minus 2400. This I'm doing for 2008. Okay. So this is the profit before interest and tax, and the finance cost here is 10. Correct. You can see for 2008, the finance cost here is specified as 10. So that means what is it in times? Always remember this is in times. 7930 divided by 10. So that will be 793 times. Okay. Then the adjusted for 2007, it is going to be nothing but 26,400 plus 1920 minus the profit from the disposed operation, that is 9,900, right? So it is, I guess, the same value, 26,400 plus 1920, 6,400 plus 1920 minus the profit before interest and tax from the disposed operation, that is 9,900. So 18,420 is the profit before tax, and here before interest and tax, and here the finance cost is nothing but 1920. So we'll state the finance cost to be 1920, right? And thus 18,420 divided by 1920, you will get the answer in times, that is 9.59 times. Right? As per the question, it is mentioned that the interest cover has a value of 14.75 times, right? So 14.75 times. Yes? Now, I don't think it needed any adjustment here. Okay. Now, after the interest cover, I think the last value that is to be calculated, net assets turnover, right? So for your net assets turnover for 2008, firstly, what is the formula of net assets turnover? It is nothing but the turnover, or you can say the sales revenue, divided by the capital employed, or the net assets. Net assets is nothing but the capital employed. So we are going to calculate the sales revenue and the capital employed here, right? So for 2008, the sales revenue is directly stated. That is nothing but 87,300. 87,300, and it will be divided by the capital employed, that is nothing but the total assets 54,000 minus the current liabilities, that is 13,000, right? So 54,000 minus 13,000, and thus for 2008 it will be nothing but 87,300 divided by 41,000. That is going to give me a value of 2.129. I'll take it as 2.13. So 2.113 times. This is also mentioned in times. Don't get confused, guys. Okay. So this is for your 2008. Now let us do for 2007 the adjusted calculation. So for the adjusted calculation, the sales revenue is 1,18,500 minus the sales revenue earned from the discontinued operation or the disposed operation, that is 37,200, right? So 1,18,500 minus 37,200. This is the adjusted sales revenue, and obviously the adjusted capital employed is going to be nothing but, we have also calculated this earlier, that is going to simply be, wait, what are the values? Yeah. So total assets is 70,080 minus the current liabilities, which are 17,280, right? So 70,080 minus 17,280, correct? So right now it is this much, but also your operation has been disposed of, right? And its disposal was at 19.2 million. So that means you received 19.2 million, but the profit that you achieved is 2.4 million. That means the carrying value is nothing but 19,200 minus 2,400. So you will get your value, the carrying value of the operation that has been discontinued, which is nothing but 16,800, and this will be deducted here, right? So minus 16,800, because that is no more a part of your capital employed, right? So we will just take 18,300 divide by 36,000, and you're not supposed to do into 100 because it is in times, right? So it is 2.258. We'll take it as 2.26 times, right? And as per the question, it is stated as 2.24 times. Right? So we have calculated here all the necessary ratios, right? So they had asked us to calculate. You have to calculate the equivalent ratios to those in note 1 for the year ended 31st December 2008, excluding the profit on sale of the division. So you have done that and calculated. For that you've received 4 marks, right? Then again, calculate the equivalent ratios to those in note 1 above for the year ended 31st December 2007, excluding the contribution made by the division that has been sold, right? So you have excluded all the contribution. For that you've achieved another 4 marks. So here, till here you've scored 8 marks already, right? Now, from this ratios that you've calculated, we are going to now interpret the financial statements, right? Interpretation of the financial statements. Okay, guys, before doing this, we'll just take a 2-minute break. Okay, we'll return in 2 minutes. Okay, so we'll just be back in 2 minutes with the remainder, that is interpretation of the financial statements. Okay, guys, I hope we are back. Now, interpretation of the financial statements. So, here, guys, what they mentioned for the last one, analyze and compare the financial performance and the position of Griffin Company for the year ended 31st December 2008 and for 2007 based on the ratios which is calculated in part A, right? So, that means based on these ratios, whatever we've calculated, you're supposed to compare it and then provide analysis should make reference wherever relevant to the industry average equivalent ratios. Firstly, we are supposed to provide information in three brackets here. That is nothing but headers such as performance. Then we will add the next header probably, which is going to be, I'm just giving you all a base understanding of all this, what is to be mentioned and how it is to be mentioned. The position of the company, right? For 2007 and 2008, you can compare with the adjusted. If you compare that also you can mention. And lastly, you can provide a summary, right? So firstly, you have done a divisional performance, right? So here the division, maybe you can calculate for the division since they've provided you everything for the division in the statement of profit or loss. Okay, before doing this, in the performance, what will be included? It is associated mainly with the statement of profit or loss. So whatever are the ratios calculated by usage of the statement of profit or loss, information regarding that is to be provided here, be it the gross profit margin, okay, GPM, gross profit margin or operating profit margin and so on, right? So now we can actually state that what has been the conclusion or what has been the effect on the financial statements on the performance of the company due to the division being discontinued, due to the division being sold off, right? So here, guys, we have to mainly look at the statement of profit or loss. Okay, here firstly the division sold, maybe we can state, had a gross profit margin of, we'll just calculate the gross profit margin of the division itself, right? So the division which is sold off, they have been provided information here. The revenue is 37,200 and the gross profit is 15,200, right? So it is nothing but 15,200 divided by 15,000, sorry, 37,200, right? 15,200 divided by 37,200 into 100. So you will specify it like this and then state the value also. That is going to be nothing but, let me just calculate it here. It is going to be 15,200 divided by 37,200 into 100, which will give me 40.86, maybe say 40.9%, right? So that is 40.9%, correct? So the gross profit margin of the division which is disposed of, the division disposed, I can write sold, disposed, anything, had a gross profit margin of 40.9%, and also you can specify the operating profit margin and an operating profit margin. Wherever you provide information, don't just provide information without values. It will be better to the explanation, right? That as per the value reduction or as per the changes in the percentage, how you're analyzing the company's financial statements, that you're supposed to specify mainly. Okay, and maybe say the operating profit margin is nothing but, it is your operating profit is 9,900 divided by 37,200, right? So 9,900 divided by 37,200, which is going to be nothing but 37,200 into 100, which will give us a value of 26.6%, right? 26.6%, right? Now in this, maybe you can actually, bold this to present it clearly, right? Bold this value also to present it clearly, right? So we've specified here the division which is disposed of, what is the gross profit margin and the operating profit margin. Now we have specified the ratios. Now we will specify that how it is affecting the financial statements. Okay. So now we have calculated the ratios here, correct? Our ratios of operating profit margin is nothing but for 2008 it is 9.1% and for 2007 it is nothing but 22.6%, right? So, and the gross profit margin is 32%, whereas the for 2007 adjusted gross profit margin is nothing but 40.3%. So for 2007 adjusted even after disposing of the subsidiary, okay, the division disposed of had this values. From this, okay, why is it coming as bold? Just a second. Okay, it's not even able to, yeah. Yes. So from this, we can specify or we can mention that the operation disposed of had gross profit margin and operating profit margin which were similar to the adjusted 2007 profit margins, right? Because adjusted also is 40.3, right? And here it is 40.9. It is 22.6, it is 26.6, right? So it is not a big difference, right? So that means the disposed of operation is not actually making a loss to the company. So thus, so from this we can mention that the operation disposed of had a gross profit margin which were quite similar to the adjusted 2007 profit margins. It can be specified as the disposal was not solely the reason for any future uncertainties or any adverse effects, right? So it can be specified that as the disposal was not the only one or was not the only one responsible, was not solely responsible or solely the reason for any future uncertainties or adverse effects on the financial performance of Griffin Company, right? Right? Because it had very good profit margins, right? The gross profit margin was as per the adjusted profit margin, and also it was the operating profit margin was also as per the adjusted profit margin, right? Now you can say that why we have stated this, because right now see the gross profit margin in 2007 was 51% and now it is 19.3%. That means technically, sorry, it was 40.3% and now it is 32.9%. That means it has technically reduced. The operating profit margin is also reduced. So you can then specify the possible reasons for a reduction in 2008, for a reduction in the operating and gross profit margin of Griffin Company is because of maybe, they are not keeping their cost of sales well and good. They are not keeping is because of ill maintenance of probably the cost of sales, distribution expenses, and what else is there? Administrative expenses, right? Right. So the possible reasons for a reduction in these two of Griffin companies possibly because of the ill maintenance of these three for the year ended 2008, right? You can clearly specify it like this, but you have to first check whether what has resulted in these values to be so low, right? You can say the cost of sales for the 2007 were equal, right? It was not that bad, it was not that different, right? But you can see here that the distribution costs initially were 12,720 and now it has become 9,360. So that means this is also okay, but the administrative expenses has doubled. So I think it is wrong to specify that it is the ill maintenance of cost of sales and the distribution expenses, but it is only that ill maintenance of the administrative expenses which has doubled, right? It is almost doubled. So you can state something like this. Okay, you can compare them also. Doubled for the year ended 2008, right? So you can state it like this. Also, it could be possibly because of the sales revenue. The sales revenue for 2007 is 1,18,500, but for 2008 it is just 87,300, right? Administrative expenses which has doubled for the year, and also the sales revenue has reduced. Okay, I'll just clear this out. So you can specify the percentage, that by what percentage the sales revenue has reduced, right? So the sales revenue initially was 1,18,500, correct? But now the sales revenue has dropped to 87,300. But you're not comparing it with this because they've specified compare it with note 1, correct? Excluding, okay, so it is excluding the profit on sale. No issues, you can compare it with this. So initially it was 1,18,500. Now it is 87,300. So how will you identify what is the reduction percentage? It is nothing but 87,300 minus 1,18,500, right? So 1,18,500 minus 87,300. This is the difference, right? And the base you're saying is nothing but it has reduced by what value that you're supposed to identify, right? So you will take 1,18,500 as your base, correct? So 1,18,500 will be the denominator. So it will be nothing but 31,200 divided by this value, which will give you nothing but 26.32%. So I'll mention, whereas the sales revenue has reduced by 26.32%, right? So possibly because of these reasons, it has been affected, correct? Now guys, also why the sales revenue has affected, that also you can clearly mention. This is just a pointer that I've specified. Probably the sales revenue might have reduced because there might be a change of supplier. But if it is not clearly specified, you can just specify one reason that okay, there would probably be a change of supplier, or maybe there would be an inflation in the purchases because of which it is affected. But if any such things are not mentioned in the question, then in such a case, don't state too much which cannot be identified from the question given above, right? So here you can just specify why it has been reduced by stating that possibly it has reduced. But if there is some things which is mentioned for a possible reduction in the sales revenue, you can clearly specify that. So this is something that we have specified for our performance. There could be a lot of things which are specified for the performance, like for example, your finance cost could be stated, or you can also say that, I have already stated here regarding the administrative expenses. Maybe say you can state it for the finance cost, correct? So also for the finance cost, there is 1920 and now it has become just 10, right? So that possibly you can mention it in the position also, right? So now we'll do something for the position, right? So for the position, if you can see, I'm just not stating each and everything in detail, right? Because it depends upon you how you specify and clarify what could be mentioned in the interpretation. You have to interpret it yourself, right? Every time there could be a different scenario and you're supposed to actually interpret that scenario well, right? So here for the statement of financial position, you're going to look at your assets, right? And obviously not just your assets, but the calculations that you have done, right? And for that, you have your net assets turnover. So you can see the adjusted net assets turnover, it is 2.26 and it is 2.13. But you can see here that the total assets in the previous year was 70,000, but now it has reduced to 54,000, correct? And the current liabilities were also higher in the previous year, which has reduced. So that means technically overall your capital employed is reduced. But so that means if your capital employed is reduced from 2007 to 2008, but still guys, right? Or maybe it is still the same. If we are comparing these two, it is still the same. Whatever is asked in the question to compare, you compare that. If we are comparing it with the adjusted values, then yes, it has actually reduced. So here it has reduced since the previous year. Okay. So we can just specify anything regarding that. That for example, you can see your current assets, sorry, non-current assets. Okay, it is 50,400 here and now it has become 39,120, right? So that is your non-current assets which has reduced. So you can specify the reduction in that. You can also specify the reduction in the current assets, right? You can also specify that the current liabilities has reduced, but why they have reduced, how they have reduced and all that you have to understand it in detail. Now for the understanding of all of that, we are just going to go through the answer sheet, right? So it will be better if you can understand it directly from the answer sheet. We'll just click on the answer sheet, but okay. So we'll just end the examination here because I don't think there's any much to be explained anymore here, right? So we'll just explain you here the answer sheet. So guys, as we click on next for the last question, okay, all these are already complete. We have left these two incomplete because obviously we've solved them separately. We'll click on end exam and yes. Okay. So we click on exit now. Once we click on exit, how do we identify how much we've scored? You can click on mark. Okay. And from the mark, you can see pre-September 2023 exams. And that is today's one, right? Self mark. Because we did it last class also, correct? Okay. So we've scored the roll-up score of 58. I think we've got one question wrong in the section A and B. So let us just look at that question, which we have got wrong. All this is correct. Okay. Trying to identify the one which is wrong. Calculations for it, but I wrote the wrong amount, right? So if you want to go through that part again, we'll just look at the question first. What should be the carrying amount of the brand in the statement of financial position of Synergetica company as at 31st December 2005, right? So we have to calculate the value of the brand, correct? So I think that was in the last section. At 31st December 2005, Synergetica's trial balance showed a brand value of 60 million, less the accumulated amortization of 20 million, right? So that means the carrying value of it is going to be 40,000, right? Then on that date, the amortization was there, which was based on a 20-year useful life, right? So the depreciation shall be charged for 20 years, correct? An impairment review on 1st July 2005 concluded that the brand had a value in use of $25 million, right? So that means firstly we have to depreciate it to identify the carrying value at that date, right? And for that, the useful life is, I guess, 25 or 20 years. Yeah, 20. Yeah, less amortization. Yeah, 20 years useful life. And the depreciation is charged till 1st July, right? Because on 1st July there is a review. So only 6 months of depreciation is to be charged, right? Into 6 by 12. So it will be nothing but 40,000 into 1 divided by 20 into 6 divided by 12. So the depreciation is 1000 and thus the carrying value is going to be 39,000, correct? So the carrying value is 39,000 and on that date the value in use, guys, is 25 million, right? So the value in use is 25 million, or you can say 25,000, right? And on that date it had a remaining useful life of 6 years. However, on the same date, Synergetica company received an offer to purchase the brand at 32 million and an administration fee of 2 million was there. That means fair value less cost to sell is nothing but, right? Fair value less cost to sell is going to be nothing but 32,000 minus 2,000, which is the administration fee, 30,000. So we will take the higher amount, that is 30,000, right? We have to identify, what is the question asking for? We have to identify the brand carrying amount. Okay, what is the carrying amount of the brand in the statement of financial position? Okay, so it is at 31st December. So we did not charge depreciation after this, right? So firstly, what is the recoverable amount? What is the amount at which it will be stated? That is the maximum recoverable amount is nothing but 30,000, correct? The maximum recoverable amount is 30,000 and at this value it will be stated, and on this date the remaining useful life as stated is 6 years. So 1 divided by 6, depreciation for 6 years into 6 divided by 12, because we have to charge depreciation for 6 months, correct? That is from 1st July to the year end. So it will be nothing but 30,000 divided by 6 into 6 divided by 12, correct? So our depreciation is going to be 2,500 and thus the carrying value of it, at the year end is going to be 27,500. So I think we forgot to calculate that depreciation part. Okay. I hope this is clear, guys. Okay. So I think all others are clear. Yes, for 30th one, we've already, okay. For the 31st one, we've already prepared the financial statement separately that I've shown you the calculations for. Okay, and for the 32nd one, guys. So here we look at the solution which is specified here. Okay, is it opening the solution part? Okay, I've clicked on the marking scheme. Yes. So let us look at the solution, guys. How am I supposed to maximize it here? Okay, guys. So I think I'm just going to do this to see the solution. Yes, I'll just maximize it to 100%. Yeah. So now, guys, okay, these are the ratios that we've calculated. I think we got the same answers, right? 19.3%, 51.2%. Let us just look at it. Yes, 51.2 this is, right? Then we have 32.9 and 40.3. Yes, so 32.9 and 40.3. Then what else do we have? 9.1% and 22.6%. So you can see 9.1% and 22.6%. We've calculated the same amounts. 793 times and 9.59 times. Oops. Yeah. 793 times and 9.59 times here. Okay. And the last one, non-net assets turnover, it is 2.13 times, 2.26 times. Yes, 2.13 times, 2.26 times. So all our calculations here, guys, are correct. Now we'll just look at the explanation. So here they've given a brief explanation of calculations if in case anywhere it is needed. So how to calculate the profit before interest and tax, your operating profit, maybe you can specify for that, right? Then they've dealt with the performance. So in the performance, as I told you, you can compare the division which is profitable, right? The profitable division has been sold off, right? So they have actually specified that. Also, they have specified the comparative sales which has increased and everything. So that also can be clarified here. Okay. Then you can mention other matters, if any, which are to be specified, like for your interest finance cost, which is there. Your finance cost, you can now cover the finance cost 793 times, right? But initially you were only able to cover 9.59 times, probably because the finance cost earlier was quite high. That means the company that has been disposed of probably had a lot of debt, because of which there was a higher finance cost which was being paid. So since they discontinued it, after that, the finance cost is saved. So you can state it in other matters, and eventually you're going to provide for a summary that Griffin Company has disposed of a profitable division, albeit one that is specified that it is viewed as no longer a good fit for the company's strategy. However, the picture is one of the significant deterioration in the profitability, even excluding the results of the division sold, and cannot be solely blamed on that, right? So if there is a reduction in the profitability, it cannot be solely blamed on the operation which has been disposed of. Obviously, the operation might have taken a lot of debt, is the reason why it has been disposed of, right? So the impression of the contracting business despite increased sales, excluding the revenue of the division, is also given by the use of the sales proceed to pay off the loan notes rather than to expand. So that is what is clarified here, is the reason why what they are trying to state is that now you can actually pay off the finance cost easily by the profit that is being generated, because probably initially when it was there in existence, you can see here. Okay, you cannot see here because I have to go back to the question. So that means if you remember, the finance cost initially was just 10. Now it has just reduced to 10. Initially it was 1920. So is the reason why there is a lot of difference in the finance cost. So you can state it in other matters. Okay. And lastly, provide a summary. So you can see here, for performance, maybe 3-4 paragraphs are mentioned, for other matters 1 paragraph, and for summary 1 paragraph. So like that, you can provide an information of 4-5 paragraphs in order to score in examination 12 marks for your analysis or interpretation of the financial statements, and for the remaining ratios 8 marks will be given. So that means technically it is actually beneficial, or it is actually good for you to score at least 14 to 15 marks if in case you're bad at it, right? If in case you're bad at analysis, at least you can score 14 to 15 marks here. Okay. And if you're very good at it, you will extend up to 17 to 18 marks, right? But do ensure that at least you know all the formulae and all the ratios, and you can interpret, correctly, that what you're supposed to interpret, how you're supposed to interpret within the financial statements, right? So I hope this is clear, guys. With this, we are done with the mock paper. I will not be able to solve the second mock paper because already our time is exceeded and I've completed the classes for your YouTube sessions. So I hope this mock paper was clear to you all. Here we have dealt with our operating cash. Here we have dealt with our consolidation profit or loss with goodwill calculation. So we have covered a lot actually. We've also done in the sample questions and individual financial statements. We've also done 2 sums in the sample questions as well for consolidated statement of financial position and profit or loss. And we've solved a complete mock paper, and we are clear with the consolidated chapter, be it for the statement of profit or loss or the statement of financial position. So I hope the whole gamut of your YouTube revision session is clear to you all. With this, guys, we'll end the session here for today and our YouTube revision classes. I hope section C will be clear to you and it will be actually scoreable in your examination. All the best for your September 2023 examination of financial reporting. You don't need to worry, just keep on studying and you'll be scoring, you'll be succeeding with flourishing marks. Thank you, everyone.